Reward credit cards. You swipe a card to buy groceries, and a few weeks later, the bank deposits cash back into your account. That is a reward credit card, and it is the most common credit card model in the United States, the United Kingdom, and Canada. The basic idea is simple. The bank gives you points, miles, or cash back every time you spend. You feel like you are getting something for free. But here is the part most people miss. You are not. Every time you swipe, the merchant pays a fee to the bank, usually between 1 and 3% of the transaction. The bank uses a portion of that fee to fund your rewards, so the cashback is not coming from the bank's generosity. It is coming from the businesses you shop at, who then quietly raise their prices to cover the cost. Which means everyone pays more, whether they use a rewards card or not. The people who benefit most are high spenders with excellent credit. The people who lose are those who pay cash or carry basic cards with no perks. Charge cards. A charge card looks exactly like a credit card, but it works differently in one important way. You must pay off the full balance every month, no exceptions. There is no option to carry a debt forward. American Express built its reputation on this model for decades. The appeal for banks and issuers is that they collect annual fees from cardholders, sometimes several $100s, rather than relying on interest income. The appeal for consumers is that it forces financial discipline. You can never spend more than you can afford to pay back within 30 days. The downside is that charge cards are typically designed for higher earners who can clear large balances every cycle, and the annual fees alone make them inaccessible to most people. As spending behavior shifted and competitors offered more flexible products, even American Express eventually introduced credit card products alongside its traditional charge cards. Subprime credit cards. Not everyone qualifies for a standard credit card. If you have a poor credit history or no credit history at all, banks consider you high risk. Subprime credit cards are designed specifically for this group, and they come at a steep price. Interest rates on subprime cards routinely exceed 25 to 30% annually. Annual fees, processing fees, and monthly maintenance fees can eat up a large portion of the card's credit limit before the cardholder ever makes a single purchase. In the United States, companies like Credit One and First Premier have built entire business models around this market. Supporters argue that these cards give people a path to rebuild their credit. Critics argue that the fee structures are predatory and trap vulnerable consumers in cycles of debt. The business model works because even if many cardholders default, the fees and interest collected from those who do not more than cover the losses. Secured credit cards. A secured credit card requires the cardholder to make a cash deposit up front, which becomes their credit limit. If you deposit $300, you can spend up to $300. The deposit sits with the bank as collateral in case you do not pay. This is the entry point that most financial advisors recommend for people who need to build or rebuild credit responsibly. The bank reports your payment behavior to credit bureaus, and if you consistently pay on time, your credit score improves over time. Many secured card issuers will eventually upgrade you to an unsecured card and return your deposit. The limitation is that you need liquid cash to lock away, which is often a challenge for the exact population that needs these cards the most. Buy now, pay later. Buy now, pay later, or BNPL, is the fastest growing credit model of the past decade, and it is quietly replacing credit cards for a generation of younger consumers. Companies like Klarna, Afterpay, and Affirm allow you to split a purchase into equal installments, often with zero interest if you pay on time. The experience is frictionless, embedded directly into the checkout process of online stores. The business model is similar to reward cards in one way. Merchants pay the BNPL provider a fee, often higher than traditional card fees, in exchange for the boost in conversion rates that comes from making purchases feel cheaper in the moment. The concern regulators are increasingly raising is that BNPL sits outside many of the consumer protections that govern traditional credit cards. Missed payments can trigger fees, and because the product is so easy to use across multiple platforms simultaneously, consumers can accumulate more debt than they realize. Store credit cards. A store credit card, also called a retail card, can only be used at one specific retailer or its affiliated brands. Target has one, Amazon has one. Nearly every major retailer in the United States offers one. The pitch is always the same. Sign up today and get 20% off your purchase. These cards carry some of the highest interest rates in the entire credit market, often above 28%. The target audience is shoppers who are loyal to a specific brand and want to maximize discounts there. The danger is that the approval process for store cards is often easier than for general-purpose cards, which means consumers who could not qualify for a standard Visa may still get approved for a retailer's card and end up paying extremely high interest on balances they cannot clear. Co-branded credit cards. A co-branded card is a partnership between a bank and a brand, an airline, hotel chain, or major retailer. The most recognizable examples are airline cards like the Delta SkyMiles card, or hotel cards like the Marriott Bonvoy card. You earn points in that specific program every time you spend anywhere, not just at the brand. The brand benefits from customer loyalty. The bank benefits from cardholder spending. The cardholder benefits from accelerated rewards, in theory. In practice, co-branded cards tend to have high annual fees, and the value of the rewards depends entirely on how effectively you can redeem points through a program with complex rules, expiration policies, and limited availability on redemptions you actually want. Central bank digital currency cards. This is the newest model, and the most contested. Several countries, including China with its digital yuan, are experimenting with central bank digital currencies, or CBDCs. Instead of your money sitting in a commercial bank, it would sit directly with the central bank and be spent through a government-issued digital card or app. The argument in favor is transparency and efficiency, less reliance on commercial bank infrastructure, lower transaction fees, and better visibility into economic activity for policymakers. The argument against is significant. A government-issued payment card would give authorities an unprecedented level of visibility into every purchase every citizen makes. In places where political freedoms are already restricted, critics argue that a CBDC card is not just a financial product, it is a surveillance tool. No major Western economy has fully launched one yet, but the debate is intensifying.